As a person who has believed in indexing all my life, I am delighted to add my voice in support of the important message of this book. The index revolution is not only a history of the growth of indexing over the past 40 years, but also a call to those who have been slow to accept this revolutionary method of portfolio management. If you are still attracted to high-expense, actively managed mutual funds, or worse, if you have chosen to invest in hedge funds, Charlie Ellis's succinct arguments, as well as his marvelous anecdotes, should leave no lingering doubts in your mind. Index investing represents a superior investment strategy, and everyone should use index funds as the core of their investment portfolios. Every year, mutual fund advertisements proudly declare that this year will be a stock picker's market. They may admit that during the previous year it was all right to be invested in a simple index fund, but they say that the value of professional investment management will become apparent in the current year. Barron's ran a cover story in 2015 and made the same case in 2016 that active portfolio managers would recapture their lost glory. In early 2014, the Wall Street Journal ran an article predicting that 2014 would be a stock picker's market. Money managers have a number of cliches they use to promote their high-priced services, and stock picker's market is one of their favorites. But year after year, when the results come in, low-cost index funds prove their worth as the optimal way to invest. Indexing outperforms in both bull and bear markets. Active management will not protect you by moving out of stocks when markets decline. No one can consistently time the market. There is no evidence to support the claim that active managers do better when there is more or less dispersion in the returns for individual stocks. Nor is it the case that indexing does worse during periods of rising interest rates. While in every year there will always be some actively managed funds that beat the market, the odds of your finding one are stacked against you, and there is little persistence in mutual fund returns. The fact that a fund is an outperformer in one year is no guarantee that it will be a winner in the next. Indeed, Morningstar, the mutual fund rating company, found that its ratings based on past performance were not useful in predicting future returns. Their 5-star rated funds, the top performers, actually did worse over the next year than the lowest 1-star rated Morningstar funds. Morningstar found that the only variable that was reliably correlated with the next year's performance was the fund's expense ratio. Funds with low expense ratios and low turnover tend to outperform funds with high turnover and high expenses, even before considering the adverse tax effects of high turnover funds. Of course, the quintessential low turnover, low expense funds are index funds, which simply buy and hold all the stocks in a particular market and do not trade from stock to stock.